Another day, another high for the markets, another record high for both the Nifty and the Sensex. We've seen global brokerages be upbeat on India. JP Morgan, of course, Morgan Stanley, CLSA and Nomura upgrade India to overweight. We've seen Goldman Sachs also upgrading Indian shares to overweight. Goldman Sachs also downgrading Hong Kong listed Chinese companies. And of course, India set to become the third largest economy by 2030, says S&P. S&P has also said India to drive Asia-Pacific growth as China's fortunes wane. So all of these brokerages upbeat on the Indian economy and Indian shares. We've also seen market cap of BSE-listed firms cross that $4 trillion mark, remember. Others, of course, in the 4 trillion club are US, China, Japan and Hong Kong. We've also seen experts look forward to and celebrate the fact that Q2 GDP growth came in at 7.6%, beating all estimates, and investors, of course, more recently cheering the three-state win for BJP, economic data and policy reforms and consistency, many believe. Now, of course, leaving that aside, if we see the Sensex alone has zoomed over 3,000 points in just December so far. So that graph really is saying the real picture as far as, the pace at which the stock markets are rising, and very, very crucial there. Now, leaving that aside, we've seen heavyweight stock surge from financials to consumption-related stocks. We've seen Adani Group stocks also continue that robust rally and surging in the last 2 days after a US agency found the accusations by Hindenburg against the Adani-led conglomerate and said they're irrelevant, essentially. So we've seen all of these stocks surge, and we've seen a market momentum really like never before. Joining to decode, for this, for all of us, joining us to decode this market momentum that is now, in the first 5 days alone of December, as we've seen the Sensex zoom over 3,000 points. We've, of course, seen in the last 2 months alone, in November, remember, we also saw FIIs turn net buyers, essentially. So we've seen so many of these multiple factors, IPOs flooding the Lal Street like never before, and all of these factors to decode really where this will take our market forward. We are joined by Sanchita Mukherjee, business economist, and Nasir Salim, managing partner at Flexi Capital. Thank you both so much for joining us. And of course, what many are asking now is, of course, we've gone through these factors that are leading to this uptick, but what is really the near-term and the long-term outlook for Indian markets? So Nasir, first to you on that.
Good afternoon, Sakshi, and thank you for having me over. I think, we've been continuing this discussion now for the last 2 to 3 days on your show. And, broadly, things remain, the same bullish that we were a few days back. The near-term outlook on the markets, I can tell you, is obviously that of optimism. We feel that this is going to continue. The probability of, this entire party getting over soon is not going to happen. We feel that, there is, of course, some downside risk on the US economy shaping up and coming, in terms of their numbers. But apart from that, I think India continues to be resilient in terms of macro data. There is, we have a huge demographic dividend supporting us in terms of consumption. And there's also this, CapEx cycle that we seem to be now getting into in terms of a revival of CapEx cycle, which is going to boost sectors linked to manufacturing, infrastructure, and those allied sectors. I think broadly, the medium to long-term view is very, very constructive as far as India is concerned. A lot of, brokerages have set out very, aggressive targets for the Sensex and the Nifty, Sakshi, and we completely believe in those numbers. I think, earnings seem to be looking robust. You spoke about GDP. I would like to add a term called economic value addition, EVA. And I think that is something which is, if you track the EVA numbers, more importantly than GDP, it will give you a fairly clear picture of where India stands. I think all the factors such as IIP, Purchase Managers Index, the banking and financial system, which is far more robust today, with gross NPAs coming down of large private sector banks and PSU banks, I think, tells you a picture that is that shows that the capital markets will continue to drive and deliver. And of course, the word of caution is, as I said to you, international. We've obviously heard this phrase before many a times that if the US, sneezes, the whole world catches a cold. I think that is something which we're not completely, away from. I think numbers on the US need to be very carefully watched, cautiously. And I think, medium to long term outlook, as I said to you, looks very, very promising as far as India is concerned on the capital markets.
Like, of course, Nasir was just mentioning, we've seen a lot of economic data also that's been upbeat. Do you now feel that infra-related stocks really will take this story forward?
Yes, absolutely. And this is a trend that we have witnessed fairly recently. To give you a little bit of a broad context of where I'm coming from, let's understand we are still having a very challenging external environment, right? We still have Russia, Ukraine, we are still having Israel, Hamas. We will be prone eventually and not insulated to any oil price shocks. If the external export demand is weak, so how is it that we are doing exceptionally so well as an economy? How are these macro indicators coming out so good? I'll tell you how. There's a basic difference between how India has managed its economy versus other major global economies in the world, right? When the external environment has been challenging, most economies have given a very, very large fiscal push. What we have done differently as an economy is that we have given a supply side push. We have gone ahead with a lot of reforms which are now coming into play, and that is indicative of the macroeconomic indicators. What are the reforms that we have done over the years, which is on the supply side? It's GST, insolvency and bankruptcy code, performance, production linked incentives, the Make in India incentives. Now, if you see the manufacturing data, manufacturing traditionally has always been in doldrums, in spite of us having a huge consuming economy. If you see the manufacturing data of Q2, the growth has jumped from 4.7 to 13.9. And that is because of the huge infrastructure push given by the government of India. It is because of the supply side addressment that we have done as an economy, and not so much on the fiscal side. We have actually been very prudent because we do not believe in creating artificial demand by printing money. So our inflation has been in check, our manufacturing is doing well, and reforms are coming into play now. The banking sector is robust, credit offtake is happening, and all of this are reflective on the earnings numbers.
All right. Now, India to drive Asia-Pacific growth as China's fortunes wane, says S&P Global. That, of course, is a significant statement. Nasir, your thoughts?
Sakshi, I personally feel that we've been struggling with data as far as China is concerned. I'm sure everybody will agree with me is that, data has been a bit of a challenge. Data sanctity has been a challenge as far as China is concerned. And, China, of course, was the mover and shaker of Southeast Asian economy until now. But things have changed, during COVID and post-COVID. There is a lot of, China plus one, which is a strategy which is developing very well, beautifully. I think, there is a lot of companies which are looking at trying to de-diversify themselves and get away from China in terms of manufacturing. We've also seen some latest news on one of the largest mobile manufacturers globally trying to look at opportunities outside of China. So I think, this entire disinvestment from China is taking shape and will take shape. And I think, India is kind of geared, very well to kind of take that and lead that as in the Southeast Asian market. Number one. Number two, I think the other very important point is that, India clearly has been, blessed with land, labor, and capital. It's always been land and labor. But we also have capital now, as rightly said, that there is capital which is available. There is private consumption, which is expected to start. We've seen a lot of heavyweight lifting which happened by the government at the center during COVID and post-COVID times. Obviously, the private sector is going to come in. So I think, if I look at all of these, at a macro level, India is obviously overweight. By many brokerage firms, India continues to be overweight, and the pie will start to move. The needle will start to move from China into other emerging economies, and India will be one of the largest beneficiaries of that.
All right, now taking it to some more stock-specific action, Nasir, really, we've seen Adani stock zoom, we've seen ITC zoom, we've seen consumption-related and financials all really surge in the past few days. But many believe going forward, will this rally be restricted to, heavyweights? Will it be broad-based in nature? Remember, earlier we did speak about the fact that, the rally is now broad-based. But going forward into 2024, how do you see the stock-specific action really going?
I wouldn't comment on stocks, Sakshi, but we can talk about sectors and we can talk about market capitalization rather on your show. I think number one, if you've seen the rally in the last few quarters, especially in the last 7 to 8 months, it's been mid and small, which have been, which have become a little expensive as we speak. Of course, earnings have come up, they're showing up, but they've become a little. If I were to compare them to relative price to earning bands, they've become a little expensive, and some of them have also become frothy. The opportunity today that we see in terms of rising is in large caps, market capitalization stocks, which are, in terms of large cap by market capitalization. I think those will tend to kind of deliver superior risk-adjusted returns on portfolios and for investors. Number two, I think, a lot of returns may get upfronted in the next a quarter or two as compared to the rest of the year. Sakshi, because we've seen a lot of good information floating around, news floating around. As I said, markets are sentiment driven. Buoyant GST collections, strong macros, political stability will get some of these earnings which will continue to show, but the returns from some of these will start to get upfronted, and it could possibly we could see. Some of these returns being upfronted over the next, as I said, 3 to 4 months on account of April and May of the general elections as well coming up. So, a clear view on the markets with good earnings and stability in terms of the government will ensure that some of these earnings get upfronted in terms of returns for investors.